Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to cover the annual report of the IRDAI, that is for 2023-24. So recently the IRDAI has released the annual report for 2023-24 and this is a very important report from the IRDAI Grade A examination point of view. So as you know that the IRDAI has announced that on the every year basis the examination will be conducted. So it is going to be a regular exam and I know that many of the aspirants are going to prepare for this examination. Okay, so this is a very good opportunity. The IRDAI Grade A is very good opportunity, and in the IRDAI Grade A exam the annual report of IRDAI is very important because direct descriptive questions come from the annual report also, and from the annual report you get a lot of material to write in your ESI component. Okay, so this annual report, it provides you the value addition points, it provides you the data points that are important for your answer writing, and so this annual report is very important from the examination point of view. So all the students that are preparing for the IRDAI Grade A or they are thinking of preparing of IRDAI Grade A, they cannot leave this very important report of the IRDAI. So let's discuss this report today and we will discuss the important highlights of the report. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the videos, the relevant videos, and do join the Telegram channel of EduTap so that you can get the PDF of the session in the Telegram channel, and the link for the Telegram channel is provided in the description box below. So good morning Aditya, Guru Raj, Bhavani, Abhay. So good morning everyone. This report, you can use the data points from this report even for the RBI Grade B examination. Let's say if a question comes on financial inclusion, so you can use the data because financial inclusion talks about the inclusion in the banking sector, in the insurance sector, in the pension sector, in the financial market segment. So you can use the data, okay? Or the question can come from the direct question can also come from the report that is relevant for the whole of the economy, okay? So let's discuss the IRDAI annual report, the important points in the report we will be discussing. It is very much important for the IRDAI Grade A, but for the RBI Grade B also, you can use the data points presented here, okay? So this is the idea. Now let's start with it. So global insurance market. First of all, let's talk about the global insurance market. So as per the Swiss Re Sigma report, the largest insurance markets globally, the first one is United States, and the total premium collected in US is more than USD 3 trillion. You can understand that US is the largest of the insurance, like US has the largest of the insurance market, and after that in the second number we have China with total premiums of US dollars 724 billion. So in the first and second there is the difference of nearly 2 trillions. Now in the third number there is UK, United Kingdom, and in the fourth number there is Japan. So these four are the largest insurance markets globally, and the first one is US, then China, then UK, and then Japan. Okay. Now Swiss Re Sigma report projects the global non-life insurance premium. So first of all, I hope you know that there is the life insurance, you are taking the life insurance so that let's say XYZ person is taking the life insurance as a retirement plan, or the XYZ person is afraid that what if I die, what if something happens to me, so how my family will be able to sustain. So in case of the person dies, in case the XYZ person dies and he or she has a life insurance, so that money will be given to the family so that the family can sustain. So if you want your financial security of your family, you can get the life insurance that can become the retirement plan, like that can provide you regular money in the retirement, or if something happens to this person, the family will get the money under the life insurance, okay? So that is the life insurance. Now the non-life insurance, all the other kind of insurance, the motor insurance, marine insurance, home insurance, car insurance, so all these insurance, the health insurance, they come under non-life category. So life insurance is related to your life, non-life is related to your assets, we can say, and your health. So this is the idea. So now Swiss Re Sigma report projects global non-life insurance premium to grow by 3.3%. So it is expected that the global non-life insurance premium to grow by 3.3% in 2024, driven mainly by continuation of hard market conditions. Hard market condition means that in the global markets, the insurance premiums are increasing. So more insurance premiums are being taken. There are less competition in the insurance market at the global level, as well as there is less risk that are taken because there is more of the checking that is happening before providing the insurance. So there are the hard market conditions where the insurance premium is collected more and there is less competition. So due to the hard market condition, due to the higher insurance premiums, there is more insurance premium that is collected. Premiums grew by 3.9% in 2023. It is expected that life insurance, the non-life insurance premium will grow by 3.3% in 2024 and 2.6% in 2025. Okay, so this is the basic idea. Now, health contributes close to half of the global non-life insurance. So, in the non-life category, there is the health insurance. Okay. So, in the non-life category, there is car insurance or motor vehicle insurance, marine insurance, home insurance, health insurance. So, in non-life category, the health contributes close to half of global non-life insurance premiums. And health premium is expected to grow by 3% in real terms in 2024. So there is the growth that is going to come in the non-life insurance premium segment by 3.3% in 2024 and by 2.6% in 2025. And in 2024, it is expected that the health premiums are going to grow by 3%. Now, Swiss Re Sigma report forecast global premiums of life insurance to grow by 2.5% in 2024. So, in the case of life insurance, there is the data that is given for 2024 and it is expected that life insurance premiums are going to grow by 2.5%. So, for the non-life insurance, the data is given, and for the life insurance, the data is given. So, in the non-life insurance, it is going to grow, the premiums are going to grow in non-life insurance by 3.3% in 2024, and in life insurance, the premiums are going to grow by 2.5% in 2024. So, it is estimated that with continued robust premium growth in both the life and non-life markets, so in life insurance markets and in non-life insurance markets, the premiums are increasing. So, global premiums, that is the life and non-life combined, will grow by 3.2% in real terms in 2024 to USD 7.6 trillion, followed by some moderation to 2.6% growth in 2025. So, it is expected that in 2024, there will be more growth in the global premiums as compared to 2025. So, in 2024, the global premiums are going to increase by 3.2% as compared to 2.6% growth that is expected in 2025. So, this is the data point, okay. So, now Indian insurance market. So, India's insurance market is one of the fastest growing globally because we have young population, we have the youth population that is going into the job market, and with the young population, there is the income that is also increasing in the country. With that, more insurance coverage is being taken, okay. So, India's insurance market is one of the fastest growing globally, and Swiss Re forecast India currently at number 10 to be the fastest growing market of the G20 over the next 5 years. So, it is the expectation or this is the data point that we are going to grow we are going to be the fastest growing market of the G20 over the next 5 years. So, this is the idea, okay. Any confusion? So, this is India insurance market is one of the fastest growing globally, and Swiss Re forecast India to be the fastest growing market of the G20 over the next 5 years, and we are currently at number 10. So, we have seen that at the global level, US, China, UK, Japan is there, France, Germany and other countries are there. Then at the number 10, India is there. The Indian insurance market faced a slowdown due to rising inflation in our country with the rising prices. You can understand that if prices are rising in our country, the focus will shift to buy, let's say we have rupees 100 and the prices are rising. So, with rupees 100, we can focus on purchasing the wheat, rice, clothes and such. So, we will not be left with the money to purchase the insurance. So, as the inflation is rising in our country, the purchasing power of the people is decreasing, and with the reduction in purchasing power, with the reduction that is coming in the purchasing power, the money is not left for the insurance premiums or for purchasing the insurance. So, with rising inflation and with changes in tax norms, the tax has been increased for the high ticket policies, for the policies that provide more coverage, or not more coverage, we can say high ticket policies are the ones that take a lot of premiums and usually are related to retirement plans and such. Okay, so high ticket policies are the ones that are related to more money, more premiums collected, more money that will be given. Okay, so this is the idea. So with the rising inflation and with the higher tax norms for the high ticket policies, there is slowdown in the Indian insurance market. Life insurance premium volumes grew by 0.6% in 2023-24. Non-life insurance premiums grew by 7.9% in real terms during 2023-24. So now rising demand. Now there is more demand for term life covers, that is for retirement plans, for annuity plans, so that after your retirement you get some money like on the regular intervals. So for the term life insurance covers, as well as if someone dies, so they are worried about their family, about the financial security of their family, so they want term life insurance. Okay, so rising demand, there is rising demand for term life covers in India. This is expected to drive real premium growth by 5%. So we have discussed about the Indian market and the global market. Now let's discuss about the penetration, the insurance penetration and density. So insurance penetration, first of all, insurance penetration is what? The insurance penetration, this is a percentage of the insurance premiums collected to the GDP, to the total GDP. So insurance penetration, it shows the insurance premiums collected as a percentage of the GDP. So insurance penetration, it shows that how much penetration is happening of the insurance. Okay, now insurance density, it is a ratio that shows us the per capita insurance premium collected. Okay, per capita or per head insurance, we can say. So insurance density, we take the insurance premiums collected divided by the total population. So that's why we can say that this is the per capita insurance premium. That is, insurance premium is let's say 1000 and the population is let's say 100. So per capita or per head, on average per capita or per head insurance premium will be 10 rupees, will be 10 rupees. So this is the idea, this is the basic idea, that per capita insurance premium, it shows the insurance premium collected divided by the total population. Okay, so insurance premium and insurance penetration and insurance density, they both are two metrics often used to assess the level of development of the insurance sector in the country. While insurance penetration is measured as the percentage of insurance premium collected to GDP, the insurance density is calculated as the ratio of premium to population. So insurance premium collected divided by the total population. So it shows the per capita premium collected or per head premium collected. So if you see the global data and if you see the Indian data, you can understand that in the life insurance category, the insurance penetration is at the same as the global level or near to the global level. So in the global level, the insurance penetration is 2.9%. In India, we have 2.8% of the insurance penetration in the life insurance category. But if we come to non-life insurance category like the marine insurance, fire insurance, home insurance, health insurance, so all of that is non-life insurance. So non-life insurance insurance penetration at the global level is 4.2%, while in India it is only 1%. So in the combined manner, the life and non-life insurance combined, that is the total insurance penetration in India is only 3.7% as compared to 7% at the global level. So we are way backward as compared to the global insurance penetration percentage. Now coming to the insurance density. So insurance density in life insurance, you can see that the insurance premium collected or the per capita premium, so that is very low in India as compared to the world level. So for the life insurance also, for the non-life insurance also, for the life insurance and for the non-life insurance, the insurance density is very low in both the categories. So in the total manner also, you can see that the insurance density is way lower than the world level. So the world insurance density is 889. So that is the per capita premium at the global level. But in India, if we take the average, the insurance density is only 95. So that is way low. That is very low. So this is the basic idea. I hope this is clear that in India, we only have the insurance density of $95. and at the world level the insurance density is 889 US dollars. So the insurance density is way low in our country. The per capita premium collected or the per head premiums are very low. Now coming to the highlights. So first of all, there are 73 total insurers registered in India as on 31st March 2024. So life insurers were 26, general insurance were 25, standalone health insurance were 8, and reinsurers and the foreign reinsurance branches in our country were 12, specialized insurers were 2. So these are the numbers. So in total 73 insurers are present in our country. Life insurance has increased by 1 in our country and standalone health insurers have increased by 2 in our country during the 2023-24. If you see the total policies that are distributed or that are issued is very high in number. The total insurance premiums collected is majorly in the life insurance. The total claims paid are also high in the life insurance. The total assets under management, total asset or total money under management is highest in the life insurance. Okay. So these are some data points that you can see. Now coming to the place of business of insurers. So as of 31st March 2024, the public sector life insurer covered 89% of districts. That means the public sector. So in the life insurance category, in the general insurance category, the insurance companies are the public sector insurance companies and private sector insurance companies. Okay. So the public sector life insurer, that is the public sector life insurance company, covered 89% of districts in terms of reaching to those districts. That was 696 out of 785 districts. While private sector life insurers covered 79% of districts, that was 621 districts by the private sector life insurers. So together the private sector and public sector in the life insurance category, together they reached approximately 90% of all districts in the country. So they are expanding their reach, the life insurance or the life insurance companies, they are expanding their reach. So in total, the life insurance offices covered all districts in 20 states out of 36 states or union territories. So 20 life insurance offices covered all districts in 20 out of 36 states or union territories. Of the 80 districts without a life insurance, so you can understand that 90% of all districts are somehow reached to, but 80 districts that are without the life insurance offices. So 73 are in northeastern states. So northeastern area is the most untouched area in the life insurance category. Okay. So this is the idea that life insurance companies, the life insurers in the private sector, in the public sector, they are trying to reach to the far off areas of the country. They are reaching to the different districts of the country, and life insurance offices have covered all districts in 20 out of 36 states or union territories, but the northeastern states are the untouched territory still. Till now, any confusion, anyone? Yes, Chandani, I have brought it. But first, let's discuss the topic, then we will discuss the descriptive, okay? Any confusion till now? So now, policies and measures to develop the insurance market. So directly a descriptive question can come from here because this is a very huge topic. So now, the modification on surety insurance guidelines. First of all, do you know that what is surety insurance? See, there are the insurance companies. Let's say there is a National Highway Authority of India, or that is there is some authority that wants to build some infrastructure. So National Highway Authority of India wants to build some infrastructure, and this contract will be given to the contractor. This contract will be given to the contractor. Now, National Highway Authority of India is very much in doubt that what if the contractor does not complete the project within time? Because then it will be very bad for the government, then it will be very bad for the image of the National Highway Authority of India, then it will be very bad because the losses will be made, because the longer a project stretches out, the longer the payments will have to be made, the more the payments will have to be made, so more losses will be made. So the National Highway Authority of India, or the authority that has given out the infrastructure project to the contractor, now National Highway Authority of India is in doubt that should we give the contract to this contractor? What if the project is not completed within time. So it is made now there is the surety insurance. There is the surety insurance that comes into picture. So the National Highway Authority of India will say that we will only give the project, the infrastructure project, to that contractor that give us some surety insurance. That means the contractor will have to give the premiums to the insurance company and will have to buy the surety insurance that will provide the surety to the National Highway Authority of India that if the terms and conditions are broken, that means if the project was set to be completed in 5 years, but if it is not completed in 5 years, whatever losses will be made in the project will be borne by the insurance company. So that is a surety insurance that is bought by the contractor for the benefit of the authority that is releasing the project. So this is the basic idea, that the National Highway Authority of India or any authority that wants to conduct infrastructure projects, so they are hiring the contractor. Now if the contractor wants to gain this contract, want to gain this project, the contractor will have to buy the surety insurance from the insurance company, and this surety insurance will secure the National Highway Authority of India or the authority that is releasing the infrastructure project. If the contractor does not follow the terms and conditions, if the project is not completed within time, or if the contractor is not adhering to the rules and regulations, then whatever losses will be made by the authority will be covered by the surety insurance. Now why the insurance companies are providing the surety insurance? Because the contractor is paying some premiums. Okay, like you buy the health insurance, no? So you pay the premiums to the insurance company and the insurance company covers your health or any disease that you might face. Okay, so that is the idea, that here the National Highway Authority of India has got the contractor has bought the surety insurance to cover the National Highway Authority of India. Got it? Any confusion? Any confusion here? Just tell me very fast, any confusion, because we have to discuss multiple topics. Any confusion in surety insurance? So on 15th May 2023, there was amendment. So there is modification that has happened in the surety insurance guidelines. Before it was said that if an insurance company is providing the surety insurance, then the insurance company will have to keep higher level of solvency margin. So insurance companies have to maintain the solvency margin of 150%. That is against their liabilities, they have to keep the assets. Okay, so solvency margin, that is against the liabilities, the assets that are being kept. So solvency margin should be 150%. But if the insurance company usually have to keep the solvency margin of 150%. But the insurance company that are releasing the surety insurance, there was the norm that they have to maintain higher solvency margin. Okay, so it was the requirement for insurers to maintain a solvency margin above 1.25 times the control level of the solvency margin. So this is the control level of solvency margin, that is 150%. So the control level of solvency margin is a minimum solvency ratio of 150% for insurance companies. But the insurance companies that are releasing the surety insurance, they had to keep 1.25 times higher of the solvency margin, of the minimum level of the solvency margin. So they had to keep higher solvency margin. So many of the insurance companies, they didn't want to give the surety insurance because they had to keep a lot of assets with themselves, because they had to maintain higher solvency margin as compared to the other insurance companies. As well as there was 30% of the contract value limit that was there for guarantee. That means if the contract value is 100 crores, so 30 crores have to be kept as guarantee with the insurance company. Okay, or there was the requirement of guarantee that was there. So now there was the amendment that happened. The guidelines were modified. So on 15th May 2023, as per the amendments to the Surety Insurance Guidelines 2022, they removed the requirement for insurers to maintain a solvency margin above 1.25 times the control level. So this requirement has been removed. So now the insurance companies do not have to follow this solvency margin that is above 1.25 times the control level. As well as there is no requirement of 30% contract value limit for guarantees. So this limit has also been lifted the restriction has also been taken away. So this is the idea. See, solvency margin. The solvency margin against the liability of the insurance company against the claims that can happen against the insurance company have to maintain some asset. So let's say 100 rupee of the claim can happen against the insurance company, so they have to maintain the asset of 150. That is 150% of the assets have to be maintained against the liability. Okay, so solvency margin is 150%. The solvency margin of is 150%, that against the claims or against the liability, the asset has to be maintained. Got it? So now there is the removal of the requirement for insurers to maintain a solvency margin above 1.25 times the control level, as well as there is the restriction that has been lifted of the 30% of the guarantee that has also been lifted. So this is the idea. Now coming to the next point, that is modification of trade credit insurance guidelines. So what has happened? See, there is the TREDS platform. There is the TREDS platform, that is trade receivables discounting system. Okay, trade receivables discounting system. So under the trade receivables discounting system, what happens? Then let's say MSME is selling a product to the buyer. Now this product is worth 1 lakh rupees, but the buyer is saying that I cannot give the money right now. So buyer is saying that I cannot give the money right now, I will be able to give money after 1 month. Okay, so here let's say the buyer is not able to give the money right now, but the buyer wants the product right now. So buyer can upload the invoice that okay, I am buying. The buyer will get the invoice that okay, you have to pay 1 lakh rupees, and buyer will upload this invoice in the TREDS platform. So this invoice is uploaded in the TREDS platform, that is trade receivables discounting system. Now the financier, now in the TREDS platform there are some financiers, that can be banks or NBFCs. Now they are seeing that the invoice is of 1 lakh rupees. Now the financier will say that okay, we will give the buyer 90,000 rupees right now, so that you can use your own money of 10,000 and you can pay to the MSME. Okay, so this is the idea, that out of this the financier bid for the invoices, and let's say the invoice of 1 lakh, the financier is saying that we will pay 90,000. So this 90,000 is given, like the buyer will accept the bid that okay, at least pay 90,000, and the financier will disburse the funds to the seller. So this 90,000 will be directly sent to the MSME, and the rest of the amount can be handled by the buyer and can be given to the MSME. Okay, now the seller receives the funds within 24 hours from the financier. Now the buyer pays the financier on the due date, that is after 1 month the buyer can pay to the like 1 lakh rupees will be paid to the financier, okay, after 1 month. So financier receives the outstanding amount. So this is the idea. Now you can understand that this is reverse, this is known as reverse factoring. This is known as reverse factoring, where the buyer is uploading the invoice in the TREDS platform and the buyer is requesting the financiers to pay to the MSME for the buy or for the purchase that the buyer has done, and buyer will pay after 1 month or after the given timeline. So this is the reverse factoring that happens. So now under the modification of trade credit insurance guidelines, it has allowed the trade credit insurance for reverse factoring on TREDS to support the MSME financing, so that the MSME financing can continue, so that the buyers can pay to the MSME in the immediate manner. It has been said that the reverse factoring will be insured. That means if the financiers are giving the money to the buyer, and let's say the buyer is not able to, like the financiers are giving the money to the MSME on behalf of the buyer. Now buyer will pay back to the financiers after 1 month or after 2 months. But what if buyer do not give back the money to the financier? So the insurance, the trade credit insurance cover is provided to the financiers to cover the default of the buyer against the invoices financed. So I hope this is clear, that the financier will finance, the buyer will provide the money to the seller on behalf of the buyer, but if buyer is not able to pay after 1 month or after 2 months, the financier will be in a tough position, because the loan has been given but the money is not coming back. So in this case the insurance can be taken. So trade credit insurance cover is provided to the financier to cover default of the buyer against the invoices financed on the trades platform. Okay, so in the trades platform there is the seller, that is usually the MSME, buyer, that can be any buyer, there is the insurance companies and the financiers. So these are the four part of the trades platform. So the buyer can join the trades platform, the sellers can join the trades platform. Sellers are usually the MSMEs, and the financiers, banks, non-banks, can join the trades platform, and the insurance companies can also join the trades platform. So the financiers, if they are afraid that what if our money do not come back, the financiers can take the insurance coverage that will cover their money that they have given, that will cover their money. If any default happens, the insurance company will return the money to the financier. So this is the idea. So it is observed that reverse factoring has over 500, it is observed that reverse factoring has over 50% of trades business volume. Okay, so it is observed that reverse factoring has over 50% share of the trade business volume, and the delinquency in both the factoring or non-factoring, the delinquency or the default is very less, is low at sub 0.1%. So more than 50% of the trade business volume is coming from the reverse factoring. That means the buyers are putting the bills in the trades platform, are putting the invoices in the trades platform to take the money. Okay, and the default is very low. So it has been said that the insurance coverage will not be very risky. Any confusion here? So we have discussed that there is modification on the surety insurance guidelines, 1.25 times of the solvency margin. This limitation has been reduced, or we can say that it was, the removal has happened of the requirement to maintain solvency margin above 1.25 times the control level. So this has been removed, as well as the limitation of 30% of guarantee has also been removed. Now modification has happened in the trades platform, that is there is the trade credit insurance for reverse factoring on the trades that has been introduced to support the MSME financing. Now next point is customer information sheet. So the customers, it has been said that the customers will get the customer information sheet, in which they will get all the important information about the insurance policy in simple language, in a snapshot. In a single page, they will get the information, important information, that is what are the premiums, as well as what is the policy name, what is the coverage that will be provided, the waiting periods, the limits, the exclusions, and the key concepts are written in the customer information sheet. Then there is the modification in product for physically disabled persons afflicted with HIV/AIDS and those suffering from mental illness. So now it has been said that equal choice will be provided to the policy holders, that if they want to take the Ayush treatment, that is the treatment through Ayurveda, Yoga, Unani, Siddh and homeopathy, so they can take the Ayush treatment, or if they want to take the allopathic treatment, that is through the medicines and drugs, so they can take that they can take that treatment also. Okay, so equal choice to the policy holders will be provided for choosing either the allopathic or the Ayush treatments, Ayush treatment, Ayurveda, Yoga and such. Now the last point is that there is unclaimed deposits and such. So till now any confusion? So this is the last point. After that we will move forward with the regulations. Any confusion in any of these 4 points? Any confusion here? So now modification to the master circular to unclaimed amounts of policyholders. So see, if there are unclaimed deposits with the banks, so banks are told by the RBI to release the information about the unclaimed deposits. Okay, so if the banks have unclaimed deposits, the banks has to release the information about the unclaimed deposits. Similarly, what is happening that the insurance companies, with the insurance companies there is a lot of unclaimed amount. So the increasing unclaimed amounts with the insurers has been identified, that with the insurance companies there are more unclaimed amounts that are being left. So this has become a concern point, because many of the people money is going to the insurance companies and it is remaining unclaimed. So it has been said under the modification regarding the unclaimed amounts, so we have to identify the unclaimed amounts with the insurance companies. So identification and efficient disbursement of the unclaimed amounts and refunds that should happen. Okay, so for that, prompt policy holders whenever the renew of policy is happening, So let's say that you have health insurance policy and you are renewing the policy, or you have life coverage, or let's say you have some car insurance policy and such, so you are renewing that policy. So prompt the policy holders during the renewal to update contact bank and nominee details, okay, so that if there is any refund amount, if there is any unclaimed amount, that can be given to the nominee. So whenever there is the renewal that is happening, so the details have to be updated, because maybe the contact number was a previous one and the buyer of the contract or the buyer of the insurance product is not aware that the contact number was older with the company, okay. So insurance companies have to prompt the policy holders during renewal to update the details about the policy holder, okay. Collaborate with credit bureaus, that is the credit information companies, account aggregators that get the data with the consent of the customers, they get the data also, and portals to trace the consumers. So if there is some refund, that has to be given to the consumers, and the details that the company has got are the earlier details, so the consumers can be traced through the collaboration with the different entities. Include reminders in communication. So whenever you are sending the messages to the policy holder, to the person, so remind the person to update the details if there is any change that has happened in the details, that is the contact details, nominee details and such. So this is the basic idea, that unclaimed amount with the insurance company should be reduced, because this is the money of the people and it should go to the people only. Now reinsurance. So reinsurance, there is the reinsurance company in our country, but India has only one reinsurance company of India, that is the General Insurance Company. The foreign reinsurance branches are also present in India, okay. So is to establish India as a global reinsurance hub. Reinsurance means that, let's say the insurance company has provided you insurance. Now the insurance company, to reduce their risk, they want to take the insurance. So if the insurance company wants to reinsure or wants to take the insurance, so there is the reinsurance companies, okay, that provide the services to the insurance companies. So reinsurance companies, they provide the services to the insurance companies. So foreign reinsurance branches, so to establish India as a global reinsurance hub, the Insurance Law Amendment Act 2015 allowed foreign reinsurers and Lloyd's London to open their branches in India. As of 31st March 2024, 11 foreign reinsurance branches, including Lloyd's, operate in the country. Now there are cross-border reinsurers also that do not have branch in India, they do not have subsidiary in India, they are providing the reinsurance in India without having any branches in India. So they are the cross-border reinsurers. They are reinsurers without a physical presence in India, so they are providing the reinsurance to the Indian insurance companies, but they do not have the physical presence in India. So this is the basic idea, okay. Now coming to the details, the regulations that have changed. So we have discussed about some modifications before, that is the policies that have been changed and such. Now let's discuss about the amendments, okay. So reinsurance services in India are provided by Indian reinsurers, the foreign reinsurance branches. So basically the reinsurance services in India is provided by the General Insurance Company, that is the only reinsurer in our country, that is Indian. The foreign reinsurance branches are providing their services in India for the reinsurance, as well as cross border reinsurers are providing their services in India. Now there is also in the IFSC, anyone knows about IFSC? It is the International Financial Service Center that is present in Gujarat in our country, that is in Gift City. So we have International Financial Service Sector in, we have the International Financial Service Center in the Gift City in Gujarat. So that International Financial Service Center, this is considered as the international platform for the financial transactions, okay. For the financial transactions, this IFSC is considered as the international platform. So there are some reinsurers that are established in the IFSC also. So there are the IFSC insurance offices, and cross-border reinsurers also provide the reinsurance services in India. So reinsurers services we get from GIC or foreign reinsurance branches or the cross-border reinsurers. Now it has been said that the Indian reinsurers, including FRBs. Now Indian reinsurer we have only one. So that cannot handle all the reinsurance. So even the foreign branches that are present in India, they are also considered the Indian reinsurers. So Indian reinsurers, including the foreign reinsurance branches, must retain a minimum of 50% of Indian reinsurance business within India. So from within India, it has been said that the insurance companies first they should take the reinsurance from the Indian reinsurers, that is the GIC, or from the foreign branches that are present in India. As well as so this 50%, it has been said that in this 50%, up to 20% can come from the IIOs, that is can come from the insurance offices that are present in IFSC, because IFSC is considered an international platform for the financial transactions, but still IFSC is present in Gujarat only. So if the insurance offices are present in IFSC, that means they are somehow investing in India. So that is good for our country. So it has been said that the Indian reinsurers, including FRBs, must retain a minimum of 50% of Indian reinsurance business, with up to 20% can come from the IFSC insurance offices also, counting towards this requirement of 50%. So this is the basic idea. As well as before, the reinsurance companies were divided into 6 levels, but now they have been divided into 4 levels. So there is category 1, that is Indian reinsurer, at present only GIC RE. Category 2 is IIOs, which invest 100% because they are the IFSC insurance companies that are present in IFSC, that is present in Gujarat. So if they invest 100% of their retained premiums, if they invest 100% of the money that they have earned within the domestic tariff area, within the Indian territory, So if the IFSC insurance companies are investing 100% of retained premiums in the Indian territory only, they will be considered category 2, and the FRBs also, the foreign reinsurance branches, will also come in category 2. Other IIOs that are not investing 100% of their retained earnings or retained premiums, so they will come in category 3. Category 4 will be other Indian insurers, only in respect of per risk, facultative placements and the CBRs, that is the cross-border reinsurers. Okay, so other Indian reinsurers as well as the CBRs, they will come in category 4. So this is the basic idea. Any confusion here? So now simplified compliance. So the compliance and the reporting requirement has been simplified for the Indian reinsurers. For the Indian insurers, minimum capital requirement for opening a new foreign like reinsurance branch in India has been lowered from 100 crores to 50 crores. So before, the capital requirement was 100 crore, which has been reduced to 50 crores for the foreign reinsurance branch, because we want more reinsurers to come into our country. So this is the basic idea. Now expense of management. So basically the IRDAI expenses of management, including commission of insurers, regulation 2024, this was amended to give insurers greater flexibility in their expenses. So before, it was said that the expense on management, so there were limits that were imposed on the different segments, that on marine insurance you can spend only this much. Let's say there is a insurance company that is providing non-life insurance. So they are providing, like Oriental is there, non-life insurance. They are providing motor insurance also. Let's say they are providing marine insurance. Let's say they are providing the home insurance. Let's say they are providing the health insurance also. So if a non-life insurance, or let's say they are providing marine insurance, motor insurance and home insurance, okay, so they are providing the multiple insurance. So for the marine insurance, there were expense limits that were imposed. For motor insurance, there were expense limits that were imposed. So before, there were segment wise limitations that were imposed, but now it has been said that the expense on management limit is not going to be segment wise, it will be on the company level, that the insurance company can, like, there will be limit on how much it can spend on the management. So now there will be company level limit that will be imposed rather than segment level limit. So it will provide more flexibility to the company to spend more where they want to expand their business more. Okay, so these amendments seek to balance operational flexibility and regulatory oversight by imposing EOM limits, expense on management limits, at the company level. Before, they were segmental level. So now it is said that it will be company level limits. Okay, these regulations combine. So these new regulations combine three erstwhile regulations, that was IRDAI expense on management of insurers transacting general or health insurance business regulations, the expense on management of insurers transacting life insurance, and the payment of commission. So these three have been combined into the new guidelines. Which second para? This one? Which second para? Okay, so Swapnil, do tell me that which second para, like in which regulations. Till then, let's move forward. So IRDAI has notified the IRDAI registration, capital structure, transfer of shares and amalgamation regulations. So there are some major changes that has been done. So see, lock-in period. So the insurers, the promoters or the establisher of the insurance companies, they have the lock-in period. So current regulation allow the relaxation in the share limits only to facilitate the listing in the National Stock Exchange and Bombay Stock Exchange. But now it has been said that such relaxation in the share or such relaxation can be provided when there is the distress situation of the insurance company. So before the relaxation in the shares, or how much shares the company can hold, how much shares the promoter can hold, when they can sell the shares. So there were certain regulations then that when you can buy the shares, when you can sell the shares. So current regulation allow relaxation only to facilitate listing in the NSE or BSE, in the stock exchanges. But now it has been said that enabling the same relaxation will be provided when there is financial distress condition in the company also, or when the shareholder or when the insurer is in the problematic kind of situation, then also the relaxations can be provided. Then also they will get the relaxation in selling their shares, or the limits will be relaxed that how much shares they can sell and so. Okay. So before the relaxation was only provided during the listing, but now the relaxation will also be provided during the distress situation. No lock-in in following cases. So there will be no lock-in period. So there is the lock-in period for the shares, for the promoters and for the big shareholders. There is the lock-in period. There is the lock-in period that you will have to keep your shares for 10 years, for 15 years, or how much percentage you will have to keep in. But there is no lock-in period for shares allotted to employees. So like Adobe employees, they have the like 25% of their income they can invest in the Adobe shares. So there is certain benefit that is provided to employees, that at 75% of the price you can invest your money. So 75 at the 75% price. So let's say the price is of 100 rupees, but at 75 rupees the employees will be getting the shares. So there are certain like shares that are allotted to employees, or the employees can get the shares at the cheaper rate, or the directors also of the insurance companies under any scheme for the employees or the directors. So they will have no lock-in period. So if the employees or directors have bought the shares under schemes or under the company's guidelines, so they will not have any lock-in period. Okay. Investors holding not more than 1% of the shares of the company, they will also have no lock-in period because they are the small investors. Nomination of director. Let's say one shareholder has nominated a director. Let's say a shareholder. Lock-in period. Lock-in period means that there is some period for which you will have to hold the shares, or there is certain limit till which you will have to hold the shares. Okay. So there are usually the relaxations that is provided in the lock-in period during the listing, or now in the financial distress situation also relaxation will be provided. Okay. For RBI, only the basic information you can understand. Okay. Now nomination of director. Let's say there is a shareholder. Let's say there is a person that is a shareholder in two insurance companies, insurance company 1 and insurance company 2. Now if the same shareholder, let's say XYZ is the shareholder in insurance company 1 and insurance company 2, and the XYZ shareholder has given the recommendation for nominating a director in the insurance company 1. Now the same shareholder cannot give recommendation for any other insurance company. So basically, no shareholder shall nominate any director on the board of any insurer or insurance company if it has already nominated director on the board of any other insurance company engaged in the same class of insurance business. So let's say the insurance company 1 and insurance company 2, they were engaged in same class of insurance business. They both were providing the life insurance business, or they both were providing life insurance. So if the shareholder has nominated a director in the insurance company 1, so the same shareholder cannot nominate the director in any other insurance company with the same class of business. So this is the idea. So in the reinsurance, see, basically the Indian insurance companies, they take the reinsurance, right? The Indian insurance companies, they take the reinsurance. So if the Indian insurance companies, they are taking the reinsurance, so 50% of the reinsurance business, 50% of the reinsurance business should go to the Indian reinsurance companies, that is the GIC or the foreign branches that are present in India. Okay. Out of this 50%, now it has been said that up to 20% of the business can go to the insurance companies that are present in the IFSC. So I hope this is clear that the 50% of the reinsurance business should go to the Indian reinsurers, that is the GIC and the foreign branches that are present in India. But out of this 50%, there is the like up to 20%, out of the 50%, up to 20% of the business, reinsurance business, can go to the IFSC insurance company that provide the reinsurance. Any confusion now, Swapnil? So now coming to the last few points. So now see, Bima Sugam, you have heard about Bima Sugam. So there are the regulations that have been brought for Bima Sugam. Bima Sugam is an online platform. Bima Sugam is the online platform where the customers can choose a suitable scheme from multiple options. So in the Bima Sugam, it is like Amazon, where you can see different, like you want to buy a mattress. So mattress are being provided by different companies. So you can see the mattress that, okay, which mattress is best for me, what is the price of the mattress, you can compare the mattresses. Similarly, for the insurance, let's say you want to buy marine insurance, let's say you want to buy health insurance or life insurance. So Bima Sugam is the online marketplace where you can see the different insurance provided by the different companies and you can compare the insurance also. I hope this is clear. Okay. So these regulations, Bima Sugam regulations have been released. These aim to establish a digital public infrastructure, the online platform named Bima Sugam, towards universalization and democratization of the insurance as well as safeguarding the policy holders' interest. So simply Bima Sugam is providing you a platform where you can see the insurance products provided by the insurance companies. You can compare the prices. You can you can buy the policy also through the Bima Sugam platform. So the marketplace will serve as a one-stop solution for all the insurance stakeholders, including customers, insurers, intermediaries and agents. So all the insurance, like the stakeholders, can join the Bima Sugam. The customers also, the insurance companies also, agents also, thereby promoting the efficiency, transparency and such. So this is the e-marketplace where you can access the insurance products. So this is the basic idea. So it is an online platform where you can access the insurance products and you can buy whatever you like. Now there is the RUSO, that is the Rural and Social Sector Obligation. So under certain sections, under the section 32B and 32C of the Insurance Act of 1938, it is said that every insurer in India, it shall undertake a specified percentage of their business in the rural and social sectors, as well as per section 32D, there is minimum third party motor insurance business that the insurer should be doing. Okay, that the insurer should be doing. So to increase the access of the insurance to the rural areas, to the social, like to the social sectors, to the agriculture area, to the farmers, to the let's say to the MSMEs and such. So to increase the reach of the insurance to such far off areas or to such downtrodden areas, there is certain compulsion that insurance companies have to provide a minimum percentage of their like a specified percentage of their business in the rural areas and to the social sectors. So this is the basic idea. So to ensure the insurance protection reaches all these segments, IRDAI constituted a committee to revisit the rural social sector and motor third party obligations. So after the comprehensive review that was done by the committee has released IRDAI, or there is the release, IRDAI has released. So after comprehensive review done by the committee, the IRDAI has released the IRDAI Rural Social Sector and Motor Third Party Obligation Regulation 2024, where the notification is being provided that we have to focus more on the rural areas, we have to focus more on the social sectors, we have to focus more on the third party like motor insurance. Okay, so minimum business obligation is there in rural sector, in social sector and in the motor third party business for insurers. So insurance companies have to focus in these areas and there are some minimum obligations that have been identified. Okay. Now, insurance grievances at a glance. So you can see that out of so many of the policies that are in force or live, the grievances are only 0.006%. So grievances or the complaints from the people are very less in the insurance market. Okay, so only 6 grievances per 1 lakh policies in force and lives covered. So the grievances in the insurance sector is very, very less. Now coming to the last slide, that is there is developmental role of the IRDAI. So IRDAI has released the Bima Trinity. In the Bima Trinity, there is Bima Sugam. Bima Sugam, that is an online platform, that is a digital platform through which the people can access the different insurance products from the different insurance companies. Now there is Bima Vistar, that is a single. So Bima Vistar, it is a single insurance. It is a single insurance product, or this is a single insurance plan. So this is an all-in-one insurance plan that is given to the people that are in the rural areas or that have low income. So this is an all-in-one insurance plan that gives policyholder coverage for life insurance, health insurance, personal accident, property risk. So if you want to get life coverage, you will buy life insurance. If you want to get health coverage, you will buy health insurance. If you want to protect your house, you will buy house insurance or home insurance. If you want to like insure your property, you will get property insurance. So now this Bima Vistar, this is all in one plan that is provided to the people with the lower income or that are present in the far off areas that do not have the income to access the different insurance products. So for that there is Bima Vistar, that is all in one insurance plan given to policy holders to cover their different risk. Then there is Bima Vahak. Bima Vahak or Bima Didi, this is to reach to the far off areas, to provide information, to provide the knowledge about insurance to far off areas. The women in the local areas are being employed or are being trained to provide the knowledge of insurance to those areas. Okay, so the local women are being trained to inform and to provide the knowledge about insurance to the far off areas. So this is the idea that Bima Vahak or Bima Didi, this is the localized distribution force that utilizes the women in the area to spread the information. Okay, so Bima Vahak, Bima Vistar and Bima Sugam. State insurance plan. In the state insurance plan, every state will have certain insurers that will get the lead insurer position. So every state or union territory will be assigned some insurance companies, some insurers that will be the lead insurers in that state or union territory, and with the collaboration with the state government, with the collaboration with the state committees, with the collaboration with the local governments, the lead insurance companies will have the responsibility to increase the insurance penetration in that state or in that union territory. So every state, every union territory will get certain insurance companies as their lead insurers that will collaborate with the state government, with the local governments to boost the insurance penetration in that area. Okay. Now there is RUSO that we have discussed. This is in the short form. RUSO is rural and social obligation. So RUSO have been redefined to improve. So we have discussed that RUSO has been redefined. There is new norm that has been released, that is IRDAI Rural Social Sector and Motor Third Party Obligation Regulation 2024. So this new regulation has been released to redefine to improve the coverage in underserved or unserved area, to reach to the far off areas, to reach to the rural areas. So there are some obligations of the insurance companies. Okay. Then there is policyholder protection. So empowering the policyholders, giving them the CIS, that is the customer information sheet, providing them with such information so that they are empowered with the knowledge, so that they know that what coverage they have and what they are getting from the policy. Okay. So this is the basic idea. So this is the developmental role. Now these are the questions for your practice. Till now, any confusion anyone has? Everything clear? So first of all, the first question is, explain the difference between the concepts of insurance penetration and insurance density in detail, highlighting the recent data for the concepts. So this is a short question of 7 marks, 100 words. The Insurance Regulatory and Development Authority of India has undertaken a series of initiatives and steps aimed at developing the insurance sector. So you have to tell about the steps taken for the steps or the initiatives taken for the development of the insurance sector. So you have to write it in the 300 words. I have shown you that Bima Sugam, Bima Vistar, State Insurance Plan, the Bima Vahak, as well as the CIS you can inform. Okay, so I have given you the points, and just you have to write it in more elaborative manner to answer this question. So this is the basic idea. Such kind of questions can directly come from your annual report. Now there is also an objective question that can come in RBI exam or that can come in IRDAI exam. So according to SRE Sigma report, the United States remains at the first position, China is in second. So the third place is with which country? So this is it. So thank you everyone. Thank you for joining the session. I hope you liked the session and I hope you understood the session. And I hope you are able to understand the different points. It was a very complicated, very lengthy report. I tried to bring out whatever was important or whatever was directly linked with the syllabus of the IRDAI Grade A. But yes, I can tell you that this report is very, very lengthy. So I have given you the important points, but I will suggest you that if you are preparing for the IRDAI Grade A examination, you have to go through the IRDAI annual report. If you have any course of IRDAI Grade A, do go through the PDF provided by the course. Do go through the PDF provided by the course for your annual report summary. Okay, so I have brought some important points, but you still have to do a lot of work and you have to do a lot of reading in the annual report, because this is one of the most important reports in IRDAI Grade A examination. No other report is so important in the IRDAI Grade A as this report. Okay. So thank you everyone. Thank you for joining. Do give the right answers of the question MCQ and do try to write in the descriptive question. I will not be able to check your descriptive answers, but you can give the pointers that what you will write, what points you will write under the questions. Okay, because you have to write it in the pointer manner. So just tell me that what points you will write in the comment section. So thank you everyone. Thank you for joining. Have a great day everyone. Thank you for joining. You're most welcome.